Finit at Capital Advantage Tutoring, and it's my job to get you past the Series 7 exam. So I'm trying to get to the whole thing through the whole Series 7. This is going to be a long one. It's all about the primary market and offerings and all that, and underwritings, the Active 33 and what's exempt or not exempt. It's going to be a long video. I'm hoping I might have to break it into two because it is so long. Because as you've known from looking at my channel, I'm not a fan of long drawn out shit. So let's start with, I want to start my company. I want to raise money. Okay. So what's going to happen? I'm actually going to do, I have a choice of a public offering or private, right? So in public, I'm going out there, I'm issuing shares to anyone, or I can do private placement where I'm only selling to a certain type of people, like the rich people, accredited investors. And if you ever want to know what an accredited investor is, remember 1, 2, 3 accredited. Yeah, get that finger up. Remember 1, 2, 3 accredited. It's either 1 million net worth, and they talk about liquid versus not house or cars. I don't think the test goes that deep, but remember, if you have 1 million liquid net worth, you're accredited. Or if you're single and you make 200 grand a year, you're accredited. Or if you're 300 grand a year, if you're married. So it's a joint account. 1, 2, 3 accredited. Also, if you have the Series 7 exam active, Series 65, or I think it's the 82, those three, if they're active, you can't just pass the exam and become accredited. You have to have an active license in good standing. That's the word they use. So a public offering is where you go to the public, you register under the Active 33, you do the registration statement, we'll get to all that, and then you sell it to the public. There's no restrictions on who can buy, stuff like that. But if you don't want to go that route, one of the exceptions is a Reg D or a private placement, where you're actually not selling to everyone. You're selling to a select few called accredited investors, which we will also get to. I have a video, I may just put it up here instead of explaining it. So private placement means you're not selling to the public. There's exceptions. You might even be exempt from registering. You should be. Or you can do a public, where you actually do a public offering. You go through the 20-day review, all that stuff. Now, also, let's talk about the other thing, a follow-on versus a primary, right? So an IPO is the first time. So an IPO is the first time you issue shares, boom. Now, that's in the primary market. So the primary market is always when the issuer is getting money, okay? The primary market is when the issuer is getting the money. So if I raise shares for my Capital Advantage Tutoring, hint, hint, guys, my company is going to get the money, okay? That's a primary offering. So it's an IPO is the first time, and then follow-ons are every time after that. So a primary offering is the first time, and then a follow-on. You can have a second, third, fourth, fifth. They're still primary offerings. But let's add another term called a secondary. And once you start in the business, a lot of people use them interchangeably. Secondary, there's a secondary. It could be a follow-on or an additional offering, whatever. Follow-on and additional mean the same thing. So a secondary is where, like me personally, I get the money. So let's say I issue 1 million shares. I own 100,000 for myself, and I decide I want to sell some of mine in an offering. That would be a secondary, because a secondary means the investor's getting the money, or one of the big people, like the partners, officers, directors, anyone really who's a control person or whatever, could do an offering. Actually, I don't know that there's any limit on who can, but you only would have to do this if you're a control person, because if you're under control and not a control person, you can sell your shares anytime you want. Control people have the restrictions. You remember the 144 rules, right? Okay. So that would be a secondary, where one of the investors or shareholders gets the money in an offering. They still have to follow the same rules, prospectuses, and all that, which we'll get to. So now let's say I actually get to the point where I'm gonna go public. There's different ways I can do this, and let's try to get it on the screen. I'm not going to go crazy doing this, but I'm just showing you what the words are because I mumble, right? So firm commitment over here means that the actual underwriter is promising to sell all the shares. So if I go to sell 1 million shares and I do a firm commitment with, say, Morgan Stanley or JP Morgan or their whole underwriting group, they're promising to sell every share no matter what, okay? So that if they only sell 600,000, I don't care, because they're going to buy the rest themselves. So that's a principal transaction, okay? Firm commitment, principal transaction, they're taking on the risk, not me. Now, best efforts is where I negotiate with the underwriter, and I say I want to sell 1 million shares, and they'll go, well, we'll do the best we can. And if whatever they don't sell, I take the shares back, unless I put some contingencies on it. So if I want to sell 1 million shares and they sell 800,000, whatever's left over, I have to take back, and I didn't sell them, I don't get the money for that. Now, if I do some contingency plan, like say a mini max, where I go, look, I want to sell 1 million, but as long as you sell 600 grand, I'm good to go. So I'm going to set a minimum of 6, and then a maximum of $1 million, because that's what I want to sell. That's as much as I want to give up. As long as I get to the 600 grand, we're good to go. We're going to go forward with it. But if it goes less than 6, we cancel the deal. Or we can do an all or none where I go, look, I want to sell the whole $1 million. If you do anything less than that, don't bother, cancel the deal. Now, what happens is if it's a contingency deal like that, usually they'll have to put the money that they get from selling the shares in an escrow account, like a side pocket account, until they hit either the 600 grand or the $1 million if it's an all or none, because then they know the deal's working. They don't want the broker dealer playing around with them. So that's it. Firm commitment, guaranteed to sell it. Best efforts, we're going to do the best we can. So we also have a standby underwriting. So a standby underwriting is like if I'm going to issue more shares. If you remember what the preemptive rights are, right? If you remember what the preemptive rights are that if I issue more shares, you as a shareholder will get these rights so that you can, whatever you want to call it, you can keep your percentage ownership. It's going to give you the ability for a very short time, like 30 to 45 days, I can't speak, to buy shares at a discount to keep your percentage ownership so you don't get diluted. You don't have to do that. So we set up a standby underwriting group. So we go, we're going to issue more shares. We issue rights to everyone. And then what happens? Then we hire an underwriter like a JP Morgan, Morgan Stanley, Merrill Lynch, whatever it is, to stand by. Any shares that are unsold to the offering, they will take and then offer it to the public. But they're doing it, they're promising to buy them. So they're going to, that's a type of firm commitment. They're going to buy the shares from me. So I'm guaranteed to sell my shares, and then they will sell them to the public for whatever they can get for it. Also, all of these underwritings, I'm not sure if it's going to be tested or not, but what they all have what they call a market out clause. Like if something crazy fucking happens, not the market going down a little bit, but like something really, it gives them an out on the contract. They can go, look, we can't sell like the pandemic or something like that. They can't, that happens. They shut everything down. They go, look, we can't sell this stuff. It's impossible. So they get an out without a penalty. It's extreme. It doesn't happen very often, hardly at all, but it is an extreme out. In case of an extreme situation, they let them out of the contract. Now we could talk about the underwriting spread, but what I'm going to do is I'm going to put the video up one of these spots. I have no idea what side it is here. And that's the video where I talk about the spread, and that'll help, and that'll save us some time. You get to that when you can. Okay, let's move on. So let's talk about the Act of 1933. So they have strict rules about what you have to do to register your shares to go public. If you go private, there's an exemption. There are a lot of exemptions, but if you want to go public, full-on registration, it's just that straight, I have no idea. You have certain rules to follow. So if you want to go public, first thing you do is you have to set up, get your underwriter. It's called the pre-registration period. You're doing this before you file your registration statement. There's not much you can do other than set up the deal, meaning decide what you want to do, how many shares you want to do, who the underwriter is, stuff like that, underwriting agreement, all that. And remember, the underwriter is the person is the firm, that the broker dealer that's taking you public, along with the syndicate of the henchmen who are going to help sell. Now, again, the video. Once you want to start this, you file the registration statement known as an S1. Okay, that's for the IPO. You do an S1, that starts the 20-day cooling off period. So that means you send it in and the SEC reviews it. They never approve. They just go, we don't have a problem with it at the end of 20 days, hopefully. You file it during this 20 days, you can't really sell the issue. What you can do is you can get indications of interest. And how do you do that? You send out a red herring. What the hell is that? A red herring is a preliminary prospectus. A lot of P's. Is that alliteration, I guess? So a lot of P's, I guess. I don't know what I'm talking about. I'm just going to ramble. So a preliminary prospectus is the disclosure doc that you have to give out to anyone who you want to buy the shares. And what's going to be missing from that is, because you can't assume anything, is the final date and the final price, but almost everything else is on there. If they have forward-looking statements, there are a lot of rules going on. That's a little deep for this exam. So if you want somebody to buy this, you send the preliminary prospectus to them, and then you go, hey, so what'd you think? Do you want to buy some? And they go, yes or no. None of it's binding. It's just kind of what they call an indication of interest. Yeah, I'm interested. So we used to have clients, and they would go, I want 10,000 shares, 5,000. We knew they weren't going to get it, but whatever. So the first thing you do, red herring, then you get indications of interest. Then you register it in the various states if it's need to. There are exceptions to that. Like if you're on an exchange, you don't have to register in the states, but we'll get into that. Probably not on this exam, maybe later. But blue sky means register in the various states. So the exam you take after this 7 will be the blue sky exam, whether it's a 63 or the 66 or the 63-65 combo, whatever. That's blue sky. And then you get, they have a due diligence meeting. I've never seen a question on it, but the due diligence meeting is where everyone gets together and they dot the I's and cross the T's, and they make sure everything's good. Now let's jump to the SEC side. They're going to review it, looking for inaccuracies. They're not looking for suitability. They're not looking for profitability. They're looking to see if everything's consistent. So they're going to, this massive document, they're going to review. They're not actually going to look at, whether it's going to work or not. I mean, if you come in there and say, hey, we have no chance of profitability, as long as you disclose that and tell the truth and show the numbers, they're going to let it go. Okay. So what they really do is, as a friend of mine in the SEC said, he goes, what they do is they bring in someone who is like an expert, or kind of like an expert, or like knows that field. So say you're going to go forward with a toy company and you announce, hey, and you put in the prospectus or the preliminary registration statement, you say, hey, we have no competition for this. Well, the person who knows the industry will go, wait a second, I don't agree with that. They won't say no. They will say, please cite your source, where you got it from, or delete. That's a deficiency notice. They're saying something's wrong. So they send you a deficiency notice saying, hey, fix this, okay? Or come up with some sources. Like if you say we're the number one in the space, okay, we're not going to disagree with you. Either show a source or delete it. That's a deficiency notice. That's as deep as they go. Because remember, at the end of 20 days, they're not approving you. No regulator ever approves anything ever. But at the end of the 20 days, they're going to declare you effective or not. Now, at the end of 20 days, they go, you're effective. If not, if they need more time, they can send you a deficiency notice and say, we need another 20 days or so. And what happens is, if you get a deficiency notice during the 20 days, they get another 20 days to review it. They won't use it. There's a lot of pressure to get it done at a quick time, but they get an extra 20 days if they need it. Now, if you get a deficiency notice after, they're going to issue a stop order or a cease and desist and say, hey, wait, stop selling because you're already effective. They go, wait, we found something wrong. Please fix this. And then once you fix it, we're good to go. Before I move on, we also have what they call a shelf registration, where they file an S3, stamp S3. So that's like for big ass companies, Wixies. We're not, again, probably not tested on this, that part. But a shelf offering is, we're going to issue now and we get immediate effectiveness. We don't have to wait to 20 days. And they let us sell it for up to 2 to 3 years. Okay. Depending on how big the company is, how we do. Again, probably not tested. But what's interesting is that you can sell it over the 2 years. You can pick when you want to do it. It's going to have less fees because you can pay as you go. You pay your fees as you go. And you get to sell, you can actually sell like every month, you can sell a little bit, or you can sell everything. Now, it's never going to be for an IPO. It'll be for an additional offering. So you pretty much have to have an IPO out there first, then you can do the shelf offering, which is good for some companies because then they go, okay, let's do the shelf. And then all of a sudden the market crashes. You go, oh, let's wait till the market comes back. Like maybe you wouldn't want to have sold your shares March 2020, right? So maybe going now, maybe the fall of 2020, the market's ripping. Maybe that would have been the time to sell because there's an appetite for buying. So that's the advantage of a shelf, is that you basically, you get the approval. I don't like the word approval, but get the effectiveness, and then you put it on. I'll put it on this shelf until I want to sell it, until I think the market's good for me. Once it's effective, as a rep, you're going to call all the people who gave you indications of interest and let them know how many shares they can buy, whatever it is. And then when you say, yes, we're going to sell it to you, then what happens is they send you the money, they buy the shares at the IPO price, whatever it is. It's been determined by the underwriters. Then they get a prospectus. The prospectus has to, the preliminary is what you do during the 20-day review. The final or statutory prospectus is the final one that has the final date, the effective date, all that stuff, all the disclosures. And that has to be delivered no later than completion of the trade. What does that mean? Pretty much settlement. And you can actually offer to them in electronic form or paper. It used to be you had to do electronic, paper all the time. Now you can do electronic as long as a paper copy is available if they need it. Okay. So the rule is access equals delivery. So if you give someone access to the prospectus, whether it's a website or a PDF or an email, that's considered delivered. Just giving them the ability to read it is considered delivery. And remember, if you're entitled to a prospectus, if you buy it from the underwriters at the public offering price, you're going to get a prospectus no later than completion of the trade. Fair enough. Okay. Now, the question is, for how many days after the IPO price are you supposed to get one? Not how many days, how many after you buy it to get it. If you buy during what period are you required to get a prospectus? Here's how it goes. Okay, if it's over the counter IPO, which means not listed on the exchange, first time issuance IPO, the first 90 days after the effective date, anyone who buys from the underwriter at the POP price will have to get a prospectus. Now, if it's an over-the-counter follow-on, remember that's a follow-on, that's an additional offering. That's like the second, third, fourth time you issue. Little less worried about it. So then it's only 40 days. Very biblical. I think it was Noah. Okay. So follow-on over-the-counter is only 40 days. Over-the-counter IPO, which means Exempt, not exchange listed, pink sheets, bulletin boards. Even though they get rid of the bulletin boards, they might mention it. It's 90 days. Now let's jump down. If it's on an exchange, NASDAQ, New York Stock Exchange, there's less restrictions because there's more restrictions to get listed. And if you're on the exchange, you're being ripped apart by all the broker dealers have research departments ripping apart your prospectus to look for mistakes. So it's a lot of scrutiny. So there's only 25 days. Now, again, if you're on an exchange and they do a follow-on, it's no days. So a follow-on the exchange, there's no prospectus requirement. Remember that. So 90, 40, 25. Remember that. So over-the-counter IPO, 90 days. Over-the-counter follow-on, additional offering, same thing, is only 40 days. Exchange-listed IPO is 25. And exchange-listed follow-on is no days. Remember, this is not how long it takes to get it. This is how long after the effective date, how many days after the effective date, you are still required to get a prospectus by completion of the trade. Now, the new issue rule, this matters to you. So basically, if we do an IPO, an equity IPO, I know the IPO is for equities, but I like to say equity IPO. If you do an equity IPO, the new issue rule says you cannot sell it to people in the business, okay? Broker dealers, hedge funds, mutual funds, money managers, client, your immediate family, stuff like that. You cannot buy an equity IPOs. Once it starts trading, have at it, but you cannot buy an equity IPOs. And that's what they have to make a bona fide, which means real effort to sell every share and not hold back any. So because what happens is if they do a firm commitment, they're going to go, oh, we had to buy some. So a hot deal, they don't basically, I'm going to say basically a million times. If we are a broker dealer, we're the underwriter and we're selling the shares, even if it's firm commitment, we have to make a bona fide effort to sell every single share. If we have to buy some our own because we can't sell it, we better make sure that we made every effort to sell those shares. Because if they find out that we bought them because we were holding back, that's called free riding and withholding. That's going to be a problem. Now, remember, it's only equity IPOs, nothing else. Not debt, not secondaries, not follow-ons, not warrants, not rights, none of that. It's strictly equity IPOs because that's the stuff that moves, right? Because if they come out with a preferred stock, it's going to go like that when it opens. But sometimes when you open up a stock, like when I was younger, we were getting in on the Yahoo deal, and I think it was being priced at 20, and the first trade was at $80. So basically, if you got shares, you got immediately 400% return. So everyone wanted that. So don't you think everyone in the business would be like, oh, give me shares? This rule is to try to make Wall Street actually sell the shares to the public, not just their buddies. So before we make a sale to someone, we have to make sure that they're not restricted. We actually have to ask the person, are you working for a FINRA member? Is anyone in your immediate family working for a FINRA member or in the business? That's considered a restricted person and they cannot buy an equity IPOs. Remember that. So when you're doing underwriting, you got to ask that question. You might even have to get, you might even have to get a written confirmation that they're not. Now, the big exception to this. So look, I work for a broker dealer, me, my family, anyone I support. If I give more than 25% support to anyone, then they would also be considered. So everyone in my household, my dogs, my kids, if I pay for more than 25% of their bills, if I'm materially supporting them, they're not going to ask the percentage. They can't buy an IPOs. But there is one big exception. If my wife if I'm married, if my husband works for the issuer. So if, say, Catch Tutoring was going to go public and I go, wait a second, I work for a broker dealer too, I get to get shares. They're not going to deny me because it's such a rare thing that they're not going to say, wait a second, you're not trying to take advantage of anything. You're just getting shares of your company that you work for. So if your spouse or someone in your immediate family works for the issuer issuing shares, that issuer, not any issuer, that issuer, you're allowed to get shares. That's a big exemption from the new issue rule. Also, if there's an investment club or a hedge fund and they have registered reps, just you're going to use the word registered reps as the rule, or restricted people, they can't buy on IPOs either unless they do there's two things they can do. One, if the restricted person is less than 10% ownership, then they're allowed. They said it's not a big deal. Or if they will carve out. Carve out is when either the fund says, okay, we're going to buy shares of the IPO, but this restricted person will get none of that. That's okay. Those are the two exceptions. If the restricted person or group of restricted people is 10% or less of the total fund, then they're fine because it's such a small amount. Or they just carve them out. They say, listen, we're going to buy it, but you're not getting anything. That's okay too. Going through that process is really freaking expensive. Okay. I mean, you're talking tens of millions of dollars to get the lawyers or prospectuses. I mean, think about this. When you go, oh, I'm going to go public, the lawyer goes, well, my normal rate's 400, but for you now it's 1,000. And also my 4 associates that I'm going to be billing you for also. So that's where we go with that. So it's expensive. So maybe we don't want to go through the Act of 33. So there are things called exempt securities. So let's go through that list. So we have like any US government, munis, nonprofit, any commercial paper, 270 days or less, anything by a bank, small business association, anything to do with like utilities, common carriers. What's a common carrier? That's like interstate commerce, like shripping. I'm gonna go crazy. Trucking, shipping, planes, interstate commerce. Those are all exempt. There's also some exempt transactions, like we're not normally exempt. We're not one of those that list of things, but we're going to do it a different way. Like maybe we're just going to sell to certain people. So let's go over Reg A. So Reg A is an exemption to the Act of 33. Reg A says, it's really A plus. So we're going to raise a limited amount of money. Okay. So here's the deal on this. So it used to be 50 million and now it's 75. So if I raise up to $75 million, I can use a Reg A plus exemption and not have to go through the full registration of the SEC. I'm still sort of registering, but it's an offering circular versus the prospectus. Okay. Okay. So Reg A plus has 2 tiers. Tier 1, which is up to 20 million. Anyone can buy. There's no real restrictions on it. And then there's tier 2, which is up to 75 million. They have a lot more things, like they have to do ongoing reporting and they have a lot of audited financials, but they also say anyone can buy, but the non-accredited investor can only buy up to 10% of their net worth. So anyone can buy. Accredited do whatever they want, and they have no limit on how many unaccredited people are, but they can't invest more than 10% of their net worth. Now, the other thing which is interesting, the Reg A plus, since it's small, they allow them to test the waters, kind of like send some information out, written or oral, to certain people. It has to go with an offering circular, but they get to kind of test the waters and gauge interest before they actually go forward with it. Unlike with an IPO, there's a whole strict quiet time. You can't talk about it during it. They allow this because they're trying to help small companies go public. Like I said, this is definitely for companies that are too small to worry about registering with the SEC. Okay, so that's Reg A. Now let's go this. What about if we're just going to issue in one state only? So this is a 147 or 147A. They're not going to go too deep into the little stuff, but we will talk about this because you need to know this stuff. So I always think of it as like Ben and Jerry's when they first went public. They did it in Vermont. They sold it to only Vermonters. I don't know what that we called. But the way I remember it is I go, Ben and Jerry's has 147 flavors. So I think a 147 offering. This is a 147 offering. It's an intrastate offering, all in one state. And what they did was, the original rule was this: it can only be sold in the state. It can only be offered in the state where your principal offer business is. You had to have at least 80% of the revenues, 80% of their assets, and 80% of the proceeds. All three you had to meet to be able to do this. So they expanded it a little bit under 147A. They allow for a little bit extra. So now you only have to meet one of those 3 things, okay? But they allow you to make offers, but not sales in other states. So the way I think of it is, somebody's in another state, you make an offer, but they can only buy it when they're in the state. So you can offer to them, you can make general solicitations everywhere to gather interest, but only people inside the state can buy it. But the offers can reach outside the state. That, I think that's all internet thing. When they first made the rule, there was no internet, so you could just offer inside Vermont and it'd only go in Vermont. Now you do something on the internet, a general solicitation, it might get outside the state. So this way it doesn't violate the rules. But remember, RAP, revenues, assets, proceeds, 80% each. of that has to be in the state. But the old rules, you had to meet all three. Now you only have to meet one of those rules. And if you buy, well, I may add one more thing. There's a fourth thing that was not on the 147 that's in this one, that a majority of the employees should be in the state. So that's one of the, you only have to meet one of those four, but they added another category, said, well, if a majority of your employees are in the state, then you can do it in the state. If you buy on a 147, I'm just going to say 147 instead of the extra stuff. If you buy a 147 from in the state, you have to hold it for 6 months fully paid before you can sell it to someone outside the state. You want to sell it to another Vermonter? I still don't know. I could have looked it up, but I didn't. I'm lazy. You can sell it to another Vermonter anytime you want. I gotta look this up. Hold on. Okay, so I like mine better. They're called Vermonters, and I guess if you move to Vermont from somewhere else, you call it Flatlander. I like mine Vermonter. It sounds more fun. But if you're a Vermonter and you buy shares on my offering in Vermont, you can sell it to other Vermonters or even Flatlanders who move there. But you can't sell it outside Vermont for at least 6 months. Then we have the Reg D. It's one of the most popular ways to raise money because there's no limits on how much you can raise. There are limits. If you sell to accredited investors, you can sell to as many as you want. You can do as much as you want, as often as you want. It's just awesome. Okay. So there's 3 levels on it. And it's a true exemption. You do not have to register. You may have to do a private placement memorandum and stuff like that. So this is what they say on all these exceptions. Okay. You still have to give the investor the information that they would have gotten in a way that they could have gotten if they had gone public anyway. So before I get into the whole 504, 506, the different types of Reg D, remember D for direct. So think Reg D for direct to the investor, to private placement. It's the issuer selling directly to investors. They may use a broker dealer, but either way, we're not going public with this. We're selling it to a certain type of person. We're selling it to accredited investors and maybe a few non-accredited, but we'll get there. So an accredited investor is someone who makes a little bit of money. And here's it. If you have the Series 7, the Series 65, the Series 82, you're considered accredited. That's new as of like 2020. The big one that everyone knows is if the 1, 2, 3 accredited, 1 million net worth, 200 grand a year salary if you're single, and 300 grand a year if you're miserable. I mean, married. Okay. So if you 1, 2, 3 accredited, that's the standard. Or if you're an officer, director, or partner of the issuer, you're considered accredited. Now let's talk about the different types. Okay, so here are the 3 different types of Reg D. The lowest one is 504. It's the easiest one. It's not the most popular, but it's easy. You can raise up to $10 million in a 12-month period. You can sell to anyone, accredited, non-accredited, no restrictions on that, but only up to 10 million in a year, but no general solicitations, no ads. You basically have to send it to certain people that you know would be interested for it. You can't just put an ad out there. Then we go up, say we want to raise more money. 506B and 506C, they're bigger. So both the 506s have no limit on the money raised, but they have some rules. So the 506B says you can sell to as many accredited as you want, but only up to 35 non-accredited. Remember, the 506s are the most popular. 506B, up to 35 non-accredited, unlimited accredited, and you cannot generally solicit. You must have some relationship or a reason to call them, okay, to reach out to them. 506C, only accredited can buy. So you can do general solicitations because think about it. The problem with 506B is grandma could technically buy on this. So general ads might get her to go in there, which is unsafe. But if 506C, only accredited investors can buy, then you can solicit all you want. Because even if grandma wants to buy it, grandma, grandpa, whatever it is, they can't because they're not, unless they are accredited. I'm just making an assumption that they're not. But 506B, up to 35 non-accredited, as many accredited, no ads. 506C, only accredited people can buy. You can do general solicitation. But remember, both 506B and C have no limit on how much money you can raise. Now let's add on to this a little bit. If you buy shares of a Reg D, they're considered restricted, which means you cannot sell them. You cannot sell them for 6 months. You have to hold them fully paid. So the reason that, think about reason, maybe it helps to remember, the reason they do this is so that you're not going to buy them because you did the research and they go, oh my God, this is bad, and flip it out to grandma or grandpa who doesn't know what they're doing. So they don't allow you to sell it for the first 6 months. So that's the most risky time or the dangerous time. So they make you hold it. Fully paid, you can't sell to anyone. Now, the good part is if you're not a partner, officer, or director, once the 6 month is over, can sell to whoever you want. You can sell every share you have, dump it after 6 months. Now, I'm going to add one caveat to that. So I don't know if it's going to be tested, but if it's an SEC reporting company, the holding is 6 months. If they don't report to the SEC their financials, then the holding period is 12 months. I don't think they're going to go in there, but I just wanted to throw in there because I'm wasting time. Now, if you want to sell it during the 6 month period, you can't, unless you sell to a QIB, QIB. A QIB is an institution. It's never an individual. So Elon Musk is not a QIB. So anyone who makes less than him is not a QIB also. At the time, I think it's 200 billion. So kind of the richest. So if a QIB wants to buy it, a qualified institutional buyer, like hedge funds, banks, insurance companies, mutual funds, stuff like that. Those are big companies that manage at least $100 million. They can buy during the 6 months because their idea is that, yeah, you can sell it to them. They can defend themselves. That's the point here, is that they can defend themselves. So we're letting them buy shares during that. They can even buy Reg S. Just, real quick, Reg S is when you issue outside the country and you can't sell it back in the country for 6 months to a year unless it's to a QIB. You can literally sell anything to a QIB. Now, let's see if you think it's unfair, right? So what happens is if you're lower, just to understand the concept here, if you're a retail investor, you have to be protected. So they're not going to let you buy a lot of things. It's kind of like your kids, right? When you have little kids, you have to protect them from everything. But as they get older, they're accredited or qualified or QIBs or institutions, they can do more things. They're more sophisticated. You let them do more things. So if we go up to accredited, they can do some things. If they're an institution, we let them to do a lot more. And then if they're QIBs, we let them kind of do anything they want because they can handle the risk like an adult. That's the process. And that's the reason they restrict people. Like last year, everyone was complaining that, there were restrictions on what they could and couldn't do on Wall Street bets. They were going crazy on Reddit. And then a lot of them got hurt because they wanted these restrictions off. They got them off and then they got their ass handed to them because they don't know what they're doing. Retail people are kind of idiots, okay? They're not idiots and say, but they're ignorant. So they don't know what's going on. So they need to be protected by FINRA so that what happens is they don't bet everything they have. If you go on Wall Street bets, just watch the YOLO shit, right? They lose all their money. Some of it's fake, but they basically go, I don't know how to tell my wife I just lost all my money and I mortgaged my house. That's the point of the protections. And that's why QIBs don't need that, because they can do their own risk. They have risk departments. Now, I'm not going to waste too much time on 144 because I've done videos. I'll try to put it up here. Done a lot of little videos on this stuff. I'll try to put it up here. But 144, I'm not going to put it on the screen. I'll just talk and hopefully get it up in the video. 144, or at least I'll put it in the descriptions. If I can't get it up here, I'll put it in the description. 144 controls two different things. Restricted shares, which we just talked about. You have to hold them for 6 months fully paid unless you use 144A in some QIBs. I might not have mentioned that. 144A is an exemption to 144 that allows you to sell to QIBs. The other one is for control people, okay? That control people, partners, officers, directors, they may or may not have a holding period. Like if they're a pod, a partner, officer, director, I'm going to call them pods, PODs, partner, officer, director, I just undid my own rule, of a restricted security, they have to hold it 6 months and then follow these rules. If they're just of a public company, they have no holding period unless there's a lockup by the company, then they can sell whenever they want. So pods have 144 restrictions, and it's great. It's in the number, right? So every 90 days, they can sell the greater of 1% of the assets, 1% of the outstanding, the 4 weeks trading volume 4 times a year. Again, the 1% of the outstanding, 4 weeks trading volume 4 times a year. 4 times a year is every 90 days. So that is allowed. Pods have to follow those rules, but they don't have a holding period unless they're also a pod of a restricted security. So again, in the video, I do have a much better job in the video. So Rule 145 is all about like reclassifications where they might need a prospectus. Basically, an issuer that substitutes one security for another, a merger or a transfer of assets from one corporation to another, they might need a prospectus. Now, the reason it didn't happen on Twitter is because it went private. He took all the shit, okay? So that's 145. It's about reclassifications, substitutions of one security for another, mergers, consolidations, or transfer of assets. Those would all have to have a prospectus or some sort of disclosure doc under the Act of 33. Stock splits, reverse stock splits, and par value changes don't really matter. Again, I already talked about Reg S. It's when you issue shares outside the country. It's like Apple issuing a bond or shares in another country. No U.S. investors buy other than Quebs, and then it can't be sold back in the U.S. for 6 months to a year. If it's a bond, it's 40 days because nobody gives a shit about bonds. Now, let's say we go back to the underwriting part, and I'm the underwriter, and or I'm selling it, and you're the underwriter. You're great job, and I give you 1 million shares to sell. But what if you have so much demand for this? You're so good at what you did, you sold too many. Well, what we're allowed to do is if you oversell by 15%, you can enact a green shoe clause where I will have to give you another 15%. So I give you 1 million shares to sell. I give you 1 million shares to sell, and then you sell another 150,000. I'll print them out. I'll give them to you under the green shoe clause. Now, if you sell more than that, that's a problem because then you're going to have to short the shares to whoever you sold it to. It's not my problem anymore. And then you're going to have to buy them. They're called underwriter covering transactions. I forget the word for it. But you as the underwriter will have to buy them in the open market at some point to cover your short. Because remember, you're selling shares that haven't been printed. So that's short. Now I'm going to talk about Reg M. Reg M as in Mary, is about manipulation of additional offerings. It's not for IPOs. This is more of a Series 57 and 24 thing, but you got to know the big picture, okay? So Reg M has 5 parts, 101, 102, 103, 104, and 105, okay? I'm not going to write it down because it's not that big. Just understand it. Reg M for manipulation, is preventing people involved in the deal from manipulating the price. Now think about this. I issue shares, IPO, good. 2 years later, I decide to issue more. Now, what happens is I'm going to issue more through an additional offering, and there's a chance for manipulation because it's trading. You don't want the underwriters or people buying it up or selling it down or whatever they're doing to make a little extra profit on me. So Reg M prevents people involved in the deal from buying or selling, from buying really. So let's talk about that. So Reg M 101 and 102 prevent underwriters or issuers or people selling their shares in the underwriting from buying shares. Okay. During a restricted period, there's a certain amount of days before we offer the shares that they're not allowed to buy the shares. Because think about it. If I'm going to offer it on Thursday and you keep buying it by pushing it up, the price is going to be higher. You're going to make more money. I'm going to make more money, but we're ripping off the customers. So Reg M is preventing people from buying shares prior to the offering to manipulate it. So 101 says, okay, people who are underwriters can't buy shares. That's the underwriter, people doing the deal. 102 says the company can't buy shares. 103 says, okay, if you're a market maker, remember, market makers are broker dealers that are buying and selling all day long. They're already a market maker in the company. And if you told them they can't buy and sell shares, that would restrict their business. So they're allowed to become passive market makers where they can buy without pushing it up. It's like a nuanced thing. Again, not too deep. 104 allows for stabilization. What the hell is that? So stabilization is when we bring the company public and we push it out there. Say the POP, the offering price is $20. Now we're worried that before the news gets out, it'll start dropping in price. So as the underwriter, this is the only form of manipulation that's actually allowed. So there's rules on this. So stabilization is good for IPOs. This one is actually good for IPOs and additional offerings, but Reg M doesn't apply to IPOs. So I'm just saying in general, stabilization is for IPOs or additional offerings. The lead underwriter can buy shares at the IPO price or lower, not higher, and he can't push it up. He or she can't push it up. So let's say the offering price is $20. That's where we sold it to the public. They can buy it at 20 or lower as long as someone else went there first. So what they call an independent bid. So if we brought it out at 20 and the first price and the highest price out there bidding is 19, we can bid 19. Okay. If somebody bids 19.10, then we can bid 19.10. If they go away, we can stay. So what the whole point is, we can't push it up, but we can prevent it from going down. So if somebody bids 19.10, we can bid 19.10. If they drop away, we can stay there and prevent it from going down because we're just going to buy shares like crazy. Buy as sellers come in. Hopefully it doesn't happen. Hopefully we offer it at 20, it goes to 21, 22, 25, and we don't do anything. Remember, we can't buy it up there. We cannot buy it above 20. So stabilizing has a lot of rules, which you don't have to worry about too much for the 7. But understand you're allowed to do it. One underwriter per day can do it. You have to let FINRA, you have to let everyone know that you're doing it. And you can't push it up. So you can't buy it at a higher price than the last sale or the bid. So either the highest bid or last sale, that's what you can buy it at, but you cannot push it up. That's the point of it. Don't worry about the nuance. The third part of Reg M is 105, manipulative short selling. So that's going to prevent people who shorting the stock to push it down, to manipulate it down. That's what people could do. So again, Reg M is the big picture. I went a little too deep into it. Reg M is all about manipulating the price of the stock, either buying it up or shorting it down or whatever it is, prior to the offering of a secondary or a follow-on, not an IPO. So let's jump into the muni world a little bit. So if we're going to issue GO bonds, or GOs are revenue bonds, MSRB writes some rules, not for the issuer, but for the underwriters. Remember that. So if we issue a GO bond, before a GO bond is issued, it needs voter approval. It has debt limits, like a limit of how much they can issue each at any time. And it has to stay inside the state. Revenue bonds have none of those. No voter approval, no debt limits, and the money can cross state lines. But before you issue a revenue bond, you have to get a legal opinion, which is a lawyer, bond counsel, saying, hey, it's legal to issue. There's no tax problems. Who's going to owe the money on stuff like that? But they will not look at the credit rating. They will not look at whether it's suitable or not. They will not look at whether it's profitable or not. They strictly look at the legal terms. Is there a lien on the property? Are they okay? Is it tax-free? And who's going to owe the money and stuff like that? Now, what they want is a non-qualified opinion. So before I issue that, I want from the bond counsel unqualified or non-qualified opinion. That means I have no issues. Qualified opinion means there's some issues. There's some qualifications, like maybe it's subject to AMT, or it's taxable, or there's a problem with the property, or we don't know who owes the money. Because remember, that whole owe the money thing is more for like industrial development bonds, that like if we have a corporate involvement, like say we're going to build what that place in the Meadowlands, or what, I forgot what it's called, the American Dream Mall, whatever the hell it is. I don't think it's called that. I forgot. I think American Dream's in Minnesota, but the one in the US, in New Jersey, there's a corporation involved. So who owes the money on the bonds? So sometimes it's an industrial development bond, and the actual mall, the company that owns the mall, that corporation owes it. And that's what the bond counsel will look at. Now, when we issue shares, issue bonds, muni bonds, it's either we have to select an underwriter, and there's two ways to do it. There's competitive and negotiated. Competitive is you file a notice of sale in the bond buyer, and then you say, hey, by the way, this is the bond, this is how much we're borrowing, this is what it's for, but no coupon. Okay, it'll say who we are, the issuer, all that stuff, but it doesn't have a coupon. And then all the underwriters get together, and then they bid on the issuer, on the issue, and then the underwriter, not the underwriter, the issuer will then choose the lowest cost to the issuer. That's competitive. And then and usually that's going to be a firm commitment, so I can pick the lowest cost, knowing that the underwriter, whatever bonds they don't sell, they're going to buy from me, so I have no risk on that. Okay. The other one is negotiated, where I know the underwriter I'm going to work with, and I talk to them, and him, and I negotiate a deal, and then they're usually going to be best efforts, where they're going to sell as many as they can. And then remember that mini maxi, all or none, that's where this comes in. Okay. Once we do the notice of sale and the bond buyer, they're going to form a syndicate, but that's probably already formed already. And they have a syndicate letter. So usually a group of broker dealers already has their syndicate set, and they say, we're going to bid on bonds between 50 million and 200 million, or 200 million and a billion, whatever it is. And they're already set that way. Inside the syndicate is a thing called the syndicate letter, which lays out what the percentages, what we want to do, whether it's divided or undivided, Eastern versus Western. Remember, Eastern means that we all try to sell our bonds at our allocations, and if anyone falls flat, the rest of them kind of pick up the slack. Like Eastern countries, like kind of what Putin's trying to do again, bring them all back. It's crap. Western is like the Wild West. You're on your own. If you don't sell your percentage, if you're part of the underwriter, you're supposed to do 10%. If you don't sell what you're supposed to, then you kind of lose out, and you have to buy the bonds because we're not helping you out. If it's a competitive, they call it a syndicate letter. If it's negotiated, they call it agreement among underwriters. I wouldn't worry about that. I don't think they're going to go that deep. Either one works for munis. So let's go back to this again. If it's an Eastern, what they call undivided, I give say I'm the manager, I decide everyone's going to do 10%. If say Goldman, because we hate them, right? No, I'm kidding. If Goldman doesn't sell what they're supposed to, we take on all of the rest of that based on our original percentages. So if they don't sell 100 grand, we are going to take 10% of 100 grand and try to sell them. And we'll keep doing that until they're all sold. That's Eastern. Okay. Undivided. We're all helping each other out. Western, if Goldman doesn't sell their shit, they have to buy them from us. Now they can try to sell them to, maybe I have a good network and I'll buy them from them, but I don't have to. That's the difference between Eastern and Western. Remember, Eastern, we're all together and we help each other out. Western, you're on your freaking own. Now, the good thing is sometimes we oversell the bonds. Like we do. So there's a thing called priority of orders. I don't know that they're gonna go here because I haven't heard a lot of people asking, but we're gonna talk about it anyway. Because you remember, pretty girls drive Mercedes. Pre-sale group designated member. So as we sell bonds, as the underwriting, we sell bonds. We may oversell, so we have to decide who gets shares. Okay, who gets them, who doesn't, who does. So pre-sale group designated member. That's usually the order. Now, what's interesting, they don't talk about it in the book, but they talk about it on the MSRB. Retail orders always come first before everything else. So in reality, the issuer can decide who is retail and how much is going to be allocated and stuff like that. So the issuer decides who is a retail customer, and they always come first before everything else. Then we go back to this. So pre-sale group designated member. So remember, we're bidding on the issue. We haven't been chosen as the issuer yet. So we will, any bonds we sell during that time, which we can do because they're exempt, those are called pre-sale orders. They get first dib because they were ride or die. They went with us even though we didn't get the deal yet. We haven't been chosen as a deal. They went with us. So pre-sale are the first ones. Okay, so they get first priority. If we sell all our bonds pre-sale, we're done. Okay, but then if there's any bonds left over, we go then to group. Group are bonds that the bond orders that were given to us after they've already announced us as a winner. Now we come in and everyone gets group orders. Now, pre-selling group, everyone in the syndicate shares the commissions or markup based on their percentages. So pre-sale group, if we sell it, then we're good to go. So we go pre-sale, anything left over, we go to group. Then the next one is designated. Designated is where the syndicate member keeps the entire commission, doesn't split. Kind of like tips, right? Either they pull the tips or they don't. It's like a waiter, waitress stuff. So designated comes third, and they come after the group because think about it, they should come after that because they're being not greedy, but they're not sharing the commission and or the markup, whatever you want to call it. Now, the people, other members can't be mad about that because if they had sold all their bonds in the group part, none of it would get to designated. So again, those are bonds that haven't been sold in the pre-seller group yet. So now they're designated. Let's say we still have bonds left over. Think of member orders as they get to buy them at the takedown price, a lower price. If you remember my video, the takedown price, and they're buying it for like their own investments. Okay, so they have to come last. Okay, they're buying it because they're trying to invest or they're trying to create a UIT or something like that. So they're obviously going to come after. Because remember, FINRA members can never, ever, ever, ever buy before a customer. Now, when these bonds are sold, okay, now here's the deal. MSRB writes the rules, can't enforce them, and they only write them for the broker dealers, banks, and dealers. The issuers don't have to follow them because of federalism, right? States don't have to follow federal law; they're exempt. So the official statement is this disclosure doc. It's like a prospectus, if you want to say. It's a disclosure doc for the municipality, but they don't actually have to write it. But MSRB writes the rules that it's going to be very hard for any of the dealers to sell it without one. So the rule is if an official statement is written, then it must be given to the customers. So any customer that buys a bond has to get an official statement. That's like their version of the prospectus. Remember, the official statement, they're not going to, some of the books try to rip down what's in it. They're not going to really kill you on what's in it. But remember, they have a preliminary official statement and an official statement, just like the prospectus, right? So the preliminary and the official statement are not considered advertising. Remember that. Any kind of disclosure doc is not advertising. You could definitely see a question on that. Now, if you buy it, if you buy a bond, you have to get the official statement if it's been written. Now, there's a thing called EMMA. EMMA is where all the information about bonds are and the settlement and all that stuff. So it's there. Now, what's interesting, when a bond is first issued, they usually have a settlement date. If they're selling the bond and a settlement date has not been figured out yet or determined, it's considered when issued, which means you can trade the bonds, but we don't know when it's going to settle. So that makes it kind of confusing, but it is what it is. So if you see when issued, that just means it's been issued, but the settlement date has not been determined. Also, I think I've done this in a couple of bond videos, but let's go over this. So you know that bonds pay every 6 months. I'm not going to go into the whole shit, but remember something. If you buy a bond after a payment date, you're going to pay accrued interest. So the problem is the first time they issue it, it might be longer than 6 months. Let's say it's a January and July bond, a J&J. Okay, not Johnson & Johnson, January and July, but we don't actually get it issued till February. Where they're not going to pay in July. They're probably going to pay in January. So that's going to be a long coupon. But anyone who buys them has to figure out, are they getting remember, they're accruing interest every day. So the dated date, remember the word dated date is only for new issues, and it only matters until the first payment date. So if they pay more than 6 months, it's a long coupon. And what happens is if you buy it in January, if you buy it in like March or April or June or August, you're going to pay accrued interest back to the issuer back to February. Say the dated date is February. We actually issue it in February. It's a January and July bond. But once it pays in January, the dated date doesn't matter anymore. So the dated date is only when the bond first starts accruing interest. And then once it makes its first payment, the dated date doesn't matter. Wow, I did it actually in one video. I thought it was going to take longer. It was a lot of shit going on. I hope this helps. Please join me every Tuesday and Thursday night, live Q&A. I'm the original doing that. I love it. I have a lot of fun. It's funny. The live sometimes, the first 5-10 minutes ends up not even being questions. It's just, well, questions more about test taking and how to take it and what should I do them last week. Come in and join. It's a lot of fun. Sometimes I go longer than 9:30. Sometimes I don't. I usually go at least till 9:30, and then everyone starts getting tired and they go to sleep, and I have to go to sleep. My family gets mad. Anyway, you'll have a good night. Please wash your hands, keep healthy, and let's go pass this exam.